Hello, trader friends. Welcome to another episode of What's the Trade? So, I know a lot of you guys have a lot of money invested in your portfolios. Maybe not everything is trading options and derivatives like Uncle Tony. Some of you do have some long term assets, and maybe you had this question: what is the best asset allocation for my portfolio? So today, keep watching as we're gonna back test. We're gonna back test a lot of things. We're gonna back test the S&P 500. We're gonna back test gold. We're gonna back test bonds, and we're gonna back test three of the most famous portfolios that people use: the famous 60/40 portfolio, the famous Ray Dalio all-weather portfolio, and the famous Hugh Henry four-quadrant portfolio. So wrap yourself, fasten your seatbelts, and let's get to it. We are very, very, very lucky that we live in the age of computers, and so much information is free out there for us to use. Today, I'm going to use one of the best backtesting tools for asset allocation called Portfolio Visualizer. Disclaimer, I'm not sponsored by Portfolio Visualizer. I would like to be sponsored by Portfolio Visualizer, but I'm not. And it's a very easy software to use. And I wanted to use it because it's going to be very graphical. It's going to tell us a lot of stuff that we need. And let's start looking at it. And I know, it's too small. Let me get myself out of the screen so you can watch the screen on its full size beautiful. So the first three comparisons that we're going to make are, I'm going to compare the S&P 500 against long-term bonds against short-term bonds. And why these three? So here in portfolio number one, we're going to allocate 100% of our money to the S&P 500. Portfolio number two, right here, we're going to allocate 100% to long-term bonds. And portfolio number three, we're going to allocate everything to short-term bonds. Now, this back testing is going to start 1985 going to 2024, and we're going to start with $10,000. I'm gonna make it. I like round numbers. Let's start with $100,000, and let's run our analysis. Boom! Like magic, here it is. First portfolio, 100% SPY. Second portfolio, 100% TLT. The third portfolio, 100% SHY. SHY is the iShares 1 to 3 year Treasury bill. And let's take a look at their returns. So if we started the three portfolios with $100,000, right now, if we invested everything on the S&P 500, we would have $816,000. If we invested it in TLT, we would have $200,000. And if we invested it in SHY, we would have $142,000. This gives us a annualized return of 10% for the S&P 500, a little bit less than 4% for TLT, and a little bit less than 2% for SHY. Why are the returns for bonds so small? Well, the reason why they're small is because, I don't know if you guys remember, interest rates have been almost zero for the last 10 years. Only Uncle Jerome started raising rates, a year and a half ago, and that's why we've had some nice returns in bonds. But before that, for the young people watching us, they've never seen interest rates so high right now, and that's why the return on the bonds are very, very small. And here we can see that the best year for the stock market was 32%, the best year for TLT was 33%, and the best year for cash was 7%. And here's where we're gonna start getting interesting. The worst year for cash was down, or short-term bonds was down 4%, and bonds and stocks both have been hurt quite a bit, 36% for the S&P and 31% for bonds. And the drawdown, the difference between the drawdown and the worst year, the drawdown is the maximum pain that you suffered during that year. So the S&P has seen a drawdown of 50%, which would be very, very painful. The bonds have seen drawdowns of 47%, and the short-term bonds have only seen a drawdown of 5%. So If you are a very conservative person that doesn't mind to have a big return but doesn't want to suffer a big drawdown, here you can start to see the differences. Now, what is the Sharpe ratio and what the hell is the Sortino ratio? So, the Sharpe ratio and Sortino ratios are very fancy names for for risk adjusted returns. What does a risk adjusted return mean? So, let me change over here to our beautiful uh, Chat GPT. I asked my friend Chat GPT to tell us what the hell is the Sharpe ratio and what the hell is the Sortino ratio. And my friend Chat GPT was kind enough to give us these beautiful definitions. So the Sharpe ratio is basically a it's a measure that measures how much money we're making for the risk we are taking. So it tells investors how much yield we're receiving and for all the added volatility that we're enduring in our portfolios. What does it mean? So if remember, if you have cash in your portfolio, your volatility is going to be very, very small. Now, if you add stocks into your portfolio, that will add another element of volatility. If you add Bitcoin to your portfolio, of course, that will add another level of volatility. So the Sharpe ratio measures how much are you getting compensated for that extra risk. So a higher Sharpe ratio means you are getting compensated more for taking that extra risk. So there you have it. A higher Sharpe ratio is good. Now, what the heck is the Sortino ratio? The Sortino ratio is also a risk adjusted measurement. But the main difference between the Sharpe ratio and the Sortino ratio is more worried about the downside. The Sortino ratio is focused on how much pain you're going to suffer for taking additional risk. For people that are more conservative, the Sortino ratio, is more appropriate to use than the Sharpe ratio because the Sharpe ratio measures volatility to the upside and to the downside. And the Sharpe ratio and the Sortino ratio mainly focuses on pain to the downside. On both cases, a higher Sharpe ratio is preferred, and in both cases, a higher Sortino ratio is preferred. So if you want to, dig deeper into the Sharpe ratio and the Sortino ratio, you can ask your friend ChatGPT, or you can just Google it. It's a very, very common thing that is used by hedge funds, by everything. Because what if you're presented two investments that give 10%, both of them? So how do you know which is the best investment to choose? The best investment to choose would be the one that has less risk, the one that has less volatility, and the one that has less downside. So now that we know how to use Sharpe ratios and Sortino's ratios, let's go back to our little table. And here we are. Let me take myself out of the screen. And here we can see that the higher the Sharpe ratio, the preferred portfolio it is. So in this example, which is a very, very basic example, the S&P has the highest Sharpe ratio and also the best Sortino ratio. So it means that we are getting compensated for all the extra risk that we're taking. So if you had two portfolios, I know it doesn't sound very conservative. Just based on this comparison, which is a very simple and maybe dumb comparison, the preferred portfolio here, of course, would be having everything in the S&P 500. Now, another comparison that people like to make all the time is let's compare some commodities. What are the two most famous commodities? I would say gold, Bitcoin, and I would say oil. Now, let's compare a portfolio based on alternatives, gold, Bitcoin, and oil. And let's see what happens. So here we can see we allocated 100% of our money to gold. We allocated 100% to the Bitcoin Trust, which is now an ETF, and 100% to oil. And wow, this is very, very interesting. So if we started in 1985 and we invested $100,000 in Bitcoin, you see, we would be living la vida loca because we would have $5.5 million. If we would invested 100,000 in gold, we would have $185,000. And if we would invested 100,000 in oil, we would have $200,000. As you can see, gold and oil have very similar returns, around 8 or 9%. But Bitcoin, oh my God, 64%. Now, looking at the Sortino ratios, the drawdowns on Bitcoin, I don't know if you can take it. Bitcoin has had drawdowns of 83%, and the worst year for Bitcoin was 82%. Now, gold is a little bit more conservative. Gold's worst year for gold was 4%, and the maximum drawdown was 18%. So if you want to sleep at night, make less money, maybe gold is a better alternative. And oil has had some big drawdowns. I don't know if you guys remember when we had COVID. Oil even went negative for a day or two, where people thought they would never use oil again because they were never going to drive a car again. They would never get on an airplane again. And that made oil go down tremendously. So this is another interesting comparison. I know no one has all their money in gold. Well, I know people that have all their money in Bitcoin, and not everybody has all their money in oil. So I just wanted to show these 3 or 6 comparisons about the stock market, long-term bonds, short-term bonds, and then the most famous commodities like gold, oil, and Bitcoin. Now it's going to get a little more interesting and a little bit more fun, because people do not only have one asset in their portfolios. They combine the assets. They mix and match. They make their own little recipe. And I want to show you 3 very famous recipes following. Recipes used by 3 very, very famous people. Ray Dalio with his all-weather portfolio, then Hugh Henry with his 4-quadrant portfolios, and then the most famous 60-40 portfolio used by a lot of money managers in the United States mainly. And everybody thinks that the 60-40 portfolio is the way to go. Now let's take a look at 3 very, very famous portfolios like we were saying. I want to show you guys one of the best investors of all time, Mr. Ray Dalio. He created this called the Ray Dalio All-Weather Portfolio. And if you want to dig deeper into the Ray Dalio Weather Portfolio, there's a ton of information on the internet, how it's composed. But mainly, here it is. It's 30% stocks, it's 55% fixed income, 15% commodities, and then he divides that mainly on this is 30% VTI, which is mainly SPY, 40% TLT, 15% IEF, and 7.5% each of commodities and gold. And as you can see, Uncle Ray doesn't have any Bitcoin, and Uncle Ray is a little bit more conservative, I would say. But this portfolio, he says, would be the best portfolio for all types of markets: bull markets, bear markets, flat markets. That's why it's called the all-weather portfolio. And I would like to put it to the test. So let's go back to our page here, and let's construct our first portfolio as the Ray Dalio portfolio. So I'm not going to put VTI, I'm going to put SPY, because I like SPY more than VTI. They're exactly the same thing, but so don't worry. I'm going to put 30% on VTI. Then he had 40% on TLT. There we go. Then he had IEF, which is medium, I would call medium length bonds. IEF, he had 15%. Then we have DBC, which is a ETF that has a lot of commodities in there, a lot of them. And I like that. Commodities are always good to have. And then he likes gold. And based on our previous back testing, we know that gold reduces the risk in our portfolios. So here we go. Portfolio number one is the all-weather portfolio. 30% equities, 40% long-term bonds, 15% medium-term bonds, then commodities and gold. Now, for our second portfolio, I want to talk about one of the best and greatest hedge fund managers that we had since from 2008 to 2018. This is Mr. Hugh Henry. Hugh Henry is a great guy. I consider him a good friend, and I've learned a lot about Hugh. And Hugh, you can follow him in the Asset Capitalist. Hugh is famous because he's now the Asset Capitalist. And you've probably seen him on CNBC, on Bloomberg, on everything. And Hugh has this four quadrant portfolio that he likes to construct. So, quadrant number one, he likes to include stocks. Quadrant number two, he likes to put bonds. Quadrant number three, he likes to put alternative investments like real estate, Bitcoin, gold, etc. Quadrant number four is cash. And of course, the percentages of all these four elements, change because macro environments change. But we are lucky enough that Hugh just tweeted a couple of days ago how he would allocate that four quadrants. And wow, we can see why Hugh was very successful because he knows what's going on. And I want to put the information he tweeted into our second portfolio. So now I'm sharing the second portfolio, and I'm going to add Bitcoin as I'm going to add /BTC Bitcoin. So Hugh here in the second portfolio, he said he would put 40% of his money in the S&P 500. He would grab onto your seats, boys and girls. He would put 40% of his money in Bitcoin, and then he would put 20% on TLT 2026 leaps. Since we cannot put 20% on our leaps here, for simplicity reasons, I put 20% on TLT. Now, also, Hugh said he would short 100 units of the Chinese yuan, of what he calls the red cabbage. So, of course, unfortunately, we cannot do that in this portfolio. But yes, we can do his four quadrants, which is right now Bitcoin, long-term bonds, and SPY. And for our third portfolio, which is the portfolio that most asset allocators use, which is the 60/40 portfolio. Now, some people say, hey, you should have stocks based on your age minus 100. What does that mean? So let's say you're 30 years old. 30 years old, you subtract 100 minus 30. That means you should have 70% of your money in stocks. If you're 90 years old, that means you should have 100 minus 90, only 10% of your money in stocks. Why? Because the older you are, the less time you have to recover from a market crash, and because you don't have so many years left, right? So that's the way people normally adjusted their percentages. In the last 10 years, where we didn't have zero interest rates, people had to take more risk to get returns and pay for their medical bills, to pay for all the stuff that they need. And this percentage allocation increased tremendously. And people were taking more risk than they were used to taking. They were putting more money into the stock market than they used to take. And that 60/40 portfolio got a little bit, I would say, distorted. But for the heck of it, let's put 60% of our money in stocks, and I'm gonna be more conservative. I'm gonna put 20% on long-term bonds and 20% in medium-term bonds, giving us I think a more rounded, more conservative portfolio. And now let's hit analyze, and there we are. Here is all-weather portfolio made famous by Mr. Ray Dalio. Here we have the Hugh Henry 2024 portfolio without the short yuan, and taking into consideration that TLT is equity. And the portfolio number 3 is the famous 60/40 portfolio. How would those portfolios backtest and return? So, of course, immediately we already knew who the winner would be. The winner would be the portfolio that has Bitcoin in their allocation. Now, 40% of your money in Bitcoin, wow, that's a heavy allocation. And we can see that the Ray Dalio portfolio returns about 8.5%. The 60/40 portfolio returns around 10%, and the Hugh Henry portfolio, Hugh is very famous for giving out very, very good returns. And you can see that his portfolio, if we backtested, would have given us 40%. Now, not everybody has the cojones, the guts, to put 40% of their money in Bitcoin. So what you can do is you can go down here and maybe tweak the Bitcoin percentage to something that makes sense for you. But based on our comparison, the maximum drawdown for Hugh's portfolio would be 46%, Ray Dalio 20%, and the 60/40 23%. So of course, the Bitcoin portfolio would have a bigger drawdown, and but here he makes a good case. We have to buy performance. Bitcoin compared to gold, Bitcoin, this market cap is very small, maybe only $1.5 trillion compared to gold, which is about $15 trillion, compared to the stock market, which is close to $60 trillion. So Bitcoin right now is still a small player. And so if you want to run with the suggestion of one of the best hedge fund managers, I would do that. Now, if you want to be more conservative, like Uncle Tony, maybe I would put 5% in Bitcoin. Maybe I would put 5% in gold. Maybe I would put 10% in different commodities, and maybe I would put 20% in medium-term bonds and see what happens. Now, the modified Tony portfolio, I made it a little bit more conservative. I reduced a lot of the risk metrics and a lot of the drawdowns, but we still were able to outperform with a 13% return compared to the 5% return for the other two portfolios. And this was just an example of how you can tweak the portfolio visualizer to make sure that you are comfortable with the risk you are taking. I want to return and show the Hugh Henry portfolio. And remember, hedge fund managers are paid by what have they done for their clients lately. So they take calculated risk, of course. They take smart risks, and they take, I would say, informed risk, informed returns, and they want to give the highest percentage. So this is an easy way for you guys to play with. Of course, each one of you is going to have different risk. Everybody's risk level is different. Everybody's you can withstand different levels of drawdowns. For example, Tony, I don't like drawdowns more than 10% of my portfolio. I've never liked it because I know if you have a drawdown more than 10%, well, then it's very hard to recover. 10, 11%, I can stomach 10, 11% drawdowns, but no more than that. So it would be a cool exercise if you can take your current portfolio, put it inside this portfolio visualizer, and see really what type of risk you're taking. Because I guess none of you guys know how much risk you're taking. Also, I know a lot of my viewers have derivatives positions in their portfolios, and I purposely did not include this derivatives here because derivatives, of course, can increase risk, can reduce risk, and I try to create these same portfolios but using derivatives. And maybe in a subsequent video, I will try to construct these three same portfolios, but in two separate ways. Doing a long short portfolio, which is something that I really, really enjoy, and maybe converting these three portfolios into 100% derivatives. Because if you have a smaller account and you don't have a lot of money, you can replicate these positions by doing defined risk option strategies. And even if you have a very small portfolio, we can create a 60-40 portfolio. We can create a rate value portfolio with derivatives in order to reduce risk. So there you have it, trader friends. If you want to know what how much risk you're taking, use the portfolio visualizer. If you want to backtest and see what portfolio performs the best over time, use the portfolio visualizer. Follow Uncle Tony. Uncle Tony is here to help you grow your pile. I'm here to help you grow your pile, reduce your risk, and you can't do anything if you can't risk it to get the biscuit, baby.